Episode 3, the Gold Reality Check. Gold is insurance, not an investment. Last episode, we exposed the silent killer. How safe money, cash, savings accounts, even bonds, is quietly being destroyed by inflation every single year. So the obvious question is, what's the antidote? And if you've been following this series, you already know the answer most people jump to: gold. But here's the problem. Most people who buy gold buy it wrong. They buy too much of it. They treat it like an investment when it's actually something else entirely. Gold won't make you rich in retirement, but it can stop you from going broke. And the difference between those two things is everything. Today, we're going to break down the exact role gold plays in a portfolio, the right amount, the right reason, and the math behind why getting the dosage wrong can hurt you just as badly as not owning any gold at all. Gold equals insurance, not investment, and dosage matters. Before we talk about using gold correctly, we need to deal with the people telling you to use it incorrectly. They're called the Moon Boys. You've seen them. YouTube thumbnails with laser eyes and stacked gold bars. Late night commercials with dramatic music. The pitch is always the same. The dollar is collapsing. Gold to 10,000. Gold to 25,000. Buy now before it's too late. And here's the thing. They might even be right about the number. Gold could hit $10,000. But the Moon Boys never tell you what that world actually looks like. If gold hits $10,000 an ounce, that probably means a loaf of bread costs $9. A gallon of milk is $12. Rent has tripled. The dollar didn't just weaken, it cratered. So yes, the gold is quote-unquote worth more, but you're not richer. You're treading water while everyone around you is drowning. Remember what we covered in episode 2. Purchasing power is the only number that matters. Gold doesn't go up, the dollar goes down. And confusing those two things is exactly how the gold marketing machine separates people from their money. Here's the classic example. In 1920, 1 ounce of gold bought a quality men's suit. Today, 1 ounce of gold still buys a quality men's suit. 100 years, same purchasing power. Gold didn't grow wealth, it preserved it. And that's a completely different job. Gold doesn't go up, the dollar goes down. So if gold's job is preservation, not growth, the real question becomes, how much do you actually need? That's the question nobody answers honestly. This is where most people get it wrong. Not because gold is bad, but because they treat it like the main course when it's actually a side dish. Let's look at the math. We compared 3 hypothetical portfolios over a 20-year period. Same starting amount, same time frame. The only difference is the gold allocation. Portfolio 1, the Moonboy portfolio. 60% gold, 40% stocks. This is the person who watched the scary commercial and went all in on gold. Over 20 years, this portfolio significantly underperformed. Not because gold crashed, gold actually did fine, but because gold doesn't compound. It doesn't pay dividends. It doesn't generate cash flow. It just sat there preserving value while the stock portion did all the heavy lifting, and there wasn't enough stock to do the job. Portfolio 2, the no gold portfolio, 100% stocks. This one crushed it on total returns. Best performing portfolio on paper. But look at 2 specific moments. 2008, early 2020. This portfolio dropped 40 to 50% in a matter of weeks. Now here's the part nobody talks about. If you're retired and pulling income from this portfolio during one of those crashes, you're selling stocks at the absolute worst time. That's called sequence of returns risk, and it can permanently destroy a retirement plan. Not temporarily, permanently. Portfolio 3, the balanced portfolio. 75% stocks, 10 to 15% gold, the rest in short-term bonds. This portfolio didn't win any races. It wasn't the highest total return. But look at what happens during the crashes. When stocks dropped 40%, the gold allocation held firm, or actually went up. That buffer meant there was no need to panic sell stocks at the bottom. The retiree could pull from their gold or bond allocation while waiting for stocks to recover. That's the entire game. Gold doesn't make you money. Gold buys you time during a crisis so your real growth engine, stocks, can recover. And you don't need 50% of your portfolio in gold to do that. You need 5 to 15%. That's the dosage. The right amount protects you. Too much poisons the portfolio. Let's talk about what actually happens when someone goes overboard on gold. Because this is the mistake that shows up over and over again. A 60-year-old, scared of the stock market, watched a few too many Moonboy videos, goes out and puts 50, 60, even 70% of their retirement into physical gold. Here's what they gave up: First, compounding, gone. Stocks have historically returned around 7 to 10% annually after inflation. Gold, roughly 1 to 2% real return over long periods. That's exactly what you'd expect from a preservation asset. But it's a disaster if gold is your primary holding. Over 20 years, the difference between 8% and 1.5% is staggering. That's not a gap, that's a canyon. And it's the compounding the gold-heavy investor sacrificed. Second, income, gone. No dividends, no interest payments, no cash flow. Gold generates zero income. If you need money in retirement, you have to sell the gold itself. And selling your insurance policy to fund your daily life defeats the entire purpose of owning it. Third, flexibility, gone. Physical gold is illiquid. You can't sell a fraction of a gold bar at the grocery store. You're dealing with coin dealers, premiums, shipping costs, storage fees, and insurance. Every transaction has friction. The irony is painful. The person who was so scared of losing money that they went heavy into gold ends up with less purchasing power than the person who just bought a simple index fund and held on. Fear is the Moonboy's business model, and over-allocation is the price you pay for listening to them. So here's how to own gold the right way. No hype, no fear, just a framework that makes mathematical sense. Rule 1, keep gold between 5 and 15% of your total portfolio. Younger and still building wealth? Closer to 5%, there's still time on your side. You need growth. Let compounding do its job. Closer to retirement or already retired? Move toward 10 to 15%. You need that stability buffer. You need the thing that keeps you from being forced to sell stocks at the worst possible moment. Rule 2, understand what form of gold you're buying. Physical gold, coins and bars, gives you zero counterparty risk. Nobody can default on a gold coin. There's no CEO, no board of directors, no fund manager between you and your metal. But there are storage costs, insurance premiums, and dealer markups that eat into the value over time. Gold ETFs, like GLD or IAU, are easier to buy and sell. They're liquid, low cost, and sit right in your brokerage account. But you're trusting a fund manager and a custodian. There is counterparty risk. You don't hold the metal. Neither option is perfect. Both have a place. The point is, know what you own and know why you own it. Rule 3, never buy gold out of fear. Buy it because you have a plan. The gold infomercials run on fear. They want you to panic buy at the worst time, usually after gold has already run up 20 or 30%. The right approach is the opposite. Decide on your percentage. Buy consistently. Don't check the gold price every day. Don't panic when it drops 10%. Don't celebrate when it jumps 20%. It's insurance. You don't obsess over the price of your homeowner's insurance every morning. You pay it, you forget about it, and you're grateful it's there if you ever need it. Gold works the same way. Let's look at where we are in this series. Episode 1, we set up the battle. Stocks versus gold, not enemies. Different tools for different jobs. Episode 2, we expose the invisible enemy. Inflation, the thing that makes quote-unquote safe money dangerous and forces you to actually invest in something. Today, episode 3, we found the shield. Gold, used at the right dosage. For the right reason, it protects a portfolio during the moments that matter most, not as an investment, as insurance. But here's the thing about a shield. It keeps you alive. It doesn't win the fight. For that, you need an engine. Something that actually grows your wealth. Something that compounds. In the next episode, we're going to challenge one of the most popular beliefs in retirement investing, the obsession with dividends. Millions of people have been told to just buy dividend stocks and live off the income. The math says that advice might be costing them a fortune. If you've ever built a portfolio around dividend yield, you're going to want to see those numbers. Make sure you're subscribed. This series builds on itself, and by episode 6, you'll have a complete framework for a portfolio that actually survives the real world. Drop a comment and tell us, what's your current gold allocation? 5%? 50%? 0? No judgment, just want to see where everyone stands. See you in episode 4.